So the global economy is on a razor's edge. Even a small shock can trigger a outright recession.
Most people think banking is simple. You deposit money in a bank, the bank lends it to someone else, and the cycle repeats. But the financial world has a shadow, a parallel system of lending, investment, and financial engineering that operates largely outside traditional banks. Known as shadow banking, this network wields enormous influence over the global economy, yet remains poorly understood by the public. Today, we'll explore how shadow banking works, why it matters, and the hidden ways it shapes economies worldwide. At its core, shadow banking involves financial activities that mimic traditional banking but are conducted by non-bank institutions. Hedge funds, private equity firms, money market funds, and other entities provide loans, create credit, or facilitate investments outside standard regulatory frameworks. This allows them to operate more flexibly, often taking risks that conventional banks cannot. While this freedom can fuel innovation and liquidity, it also introduces vulnerabilities, creating ripple effects that can impact global markets in profound ways. One key mechanism in shadow banking is securitization. This involves bundling loans such as mortgages, auto loans, or credit card debt into tradable financial products. These securities are then sold to investors, transferring risk from the original lender to the broader market. Securitization allows capital to flow rapidly, increasing liquidity and funding opportunities. However, it also obscures risk. When the 2008 financial crisis hit, securitized mortgage products amplified losses across the globe, demonstrating how shadow banking can spread instability through interconnected markets. Leverage is another defining feature of shadow banking. Unlike traditional banks, which are heavily regulated and required to maintain capital reserves, shadow institutions can borrow aggressively to amplify returns. This high leverage can generate massive profits in good times, but can be catastrophic when markets turn. Leverage magnifies risk, creating a system that is highly sensitive to economic shocks. Small disruptions in asset prices can trigger cascading effects, destabilizing markets that rely heavily on shadow banking liquidity. Money market funds play a subtle but significant role. They function like banks in many respects, offering short-term loans and facilitating payments, yet they operate without the same regulatory protections. Investors trust these funds to manage risk and maintain liquidity, but the lack of oversight can create vulnerabilities. When confidence falters, withdrawals can trigger panic, forcing rapid asset sales and creating instability. Shadow banking is therefore a delicate balance between providing capital and managing hidden systemic risks. Another critical aspect is repo markets, where financial institutions lend securities or cash overnight to manage liquidity. These short-term lending mechanisms are vital to global financial operations, yet they are often part of the shadow banking system. During periods of stress, such as in 2008 or the 2020 COVID-19 shock, repo markets can seize up, threatening the stability of broader financial networks. The reliance on these opaque markets demonstrates how deeply shadow banking underpins the functioning of global finance. Private equity firms also contribute to shadow banking's influence. By acquiring companies using borrowed money, restructuring operations, and reselling assets, these firms generate returns that ripple across industries. The reliance on debt to fund acquisitions means that leverage and risk are concentrated outside traditional banking, creating hidden channels of economic influence. These activities can boost efficiency, innovation, and growth, but they can also amplify market fragility when economic conditions deteriorate. Hedge funds represent another layer of shadow influence. Their complex trading strategies, derivatives, leverage, and arbitrage allow capital to flow rapidly across markets, affecting prices and liquidity. Hedge fund activity can stabilize markets by providing liquidity or create volatility when positions unwind suddenly. Their presence illustrates how shadow banking is not confined to lending alone. It encompasses a vast web of investment activities that shape the global financial landscape in both visible and invisible ways. Off-balance sheet activities are central to shadow banking operations. By keeping assets and liabilities off their balance sheets, institutions can bypass regulatory scrutiny, reduce capital requirements, and operate with greater flexibility. While this enhances efficiency and profitability, it also masks exposure to risk. Regulators may underestimate systemic vulnerability, and investors may misjudge the stability of the entities involved. This lack of transparency is one reason shadow banking can appear to operate in the shadows, quietly influencing economies without public awareness. Cross-border flows magnify shadow banking's global impact. Funds, securities, and loans move rapidly across countries, often taking advantage of regulatory arbitrage differences in rules between jurisdictions. This creates efficiency but also risk, as shocks in one market can propagate quickly worldwide. For example, the European debt crisis and U.S. subprime collapse demonstrated how interconnected shadow banking networks transmit instability across borders. Global finance increasingly depends on this shadow system, making international coordination and monitoring essential. Shadow banking also affects monetary policy. Central banks can influence traditional banks through interest rates, reserve requirements, and lending programs, but they have limited control over shadow institutions. As a result, monetary interventions may have unintended consequences, with liquidity flowing into unregulated channels, amplifying asset bubbles or financial instability. Shadow banking therefore creates a parallel system where policy influence is diminished, complicating efforts to stabilize the economy. Liquidity transformation is another key function. Shadow banks often transform short-term funding into long-term investments, providing capital to businesses, governments, and markets. This function is essential for economic growth, enabling investment that might not otherwise occur. However, it also creates maturity mismatches, where short-term liabilities fund long-term assets. In times of stress, this mismatch can force rapid liquidation, contributing to market crashes and systemic risk. Regulatory gaps are central to shadow banking's expansion. Because these institutions operate outside traditional banking oversight, they face fewer restrictions on leverage, liquidity, and risk management. While this flexibility drives innovation, it also creates blind spots for regulators and investors. The challenge is balancing economic growth and stability, as overregulation could stifle innovation, while underregulation leaves the global financial system exposed to hidden dangers. Shadow banking also influences corporate finance. Companies rely on these institutions for loans, funding acquisitions, and managing liquidity. The availability of alternative financing sources outside traditional banks encourages corporate risk-taking and facilitates rapid expansion. This can drive economic growth and innovation, but also increases systemic vulnerability if over-leveraged companies default during economic downturns. The interplay between shadow finance and corporate strategy underscores its profound influence on real-world economic outcomes. Derivatives markets are tightly connected to shadow banking. Complex instruments such as credit default swaps, interest rate swaps, and options are often traded outside traditional banking channels. These instruments provide risk management and speculation opportunities, but they also concentrate exposure in ways that can cascade during market stress. The 2008 crisis highlighted how derivative-linked shadow banking activities can amplify losses and transmit shocks globally, demonstrating the system's hidden influence on real-world markets. Shadow banking also affects investment cycles. By providing alternative funding for startups, venture capital, and emerging industries, shadow institutions can accelerate technological adoption and industrial growth. Conversely, the sudden withdrawal of shadow capital can stall innovation, constrain liquidity, and contribute to industry-wide slowdowns. The ebb and flow of shadow banking influence, therefore, shape both growth trajectories and economic vulnerabilities across sectors. Confidence is perhaps the most fragile element in shadow banking, because much of its activity relies on trust. Investors trusting that assets can be redeemed, borrowers trusting that funding will remain available. Panic or uncertainty can propagate rapidly. Unlike traditional banks, which have explicit government backing or deposit insurance, shadow banking lacks formal safety nets. When confidence falters, liquidity can vanish overnight, triggering market-wide consequences. Despite risks, shadow banking is a critical engine for global economic growth. It provides flexibility, liquidity, and capital that traditional banks cannot, supporting entrepreneurship, innovation, and investment. Many economies rely on it for financing critical sectors, infrastructure projects, and industrial expansion. Understanding its mechanisms helps explain how capital flows in modern markets, why economies can grow rapidly, and why financial crises sometimes emerge unexpectedly. The next time markets move unpredictably or a financial crisis emerges seemingly out of nowhere, remember, the The shadow banking system is likely at work, silently shaping capital flows, risk, and economic outcomes around the world. Understanding it is no longer optional. It's essential for anyone seeking to comprehend the hidden forces driving global finance in the 21st century.